years. I'm kind of like, yeah, no, yeah. But eventually.
Good morning. Let's start making our way to our tables. We're going to get started in just a minute. Well, so good to see you.
Thanks. It's really good to see you. It's been way too long.
So have you met Brandon? Yeah, because he'll control the slides, so you might figure out how you're going to say next. Yeah. How do you do? I do. Good to see you. All right, good morning. Welcome to the March meeting of the North County Estate Planning Council, San Diego. Thrilled to have you all here. If you could make your way to your seats, that would be just fantastic. But in any case, we're going to keep on moving. Obviously, another beautiful day at Loma Santa Fe Country Club. We've been here since October, and it's been a most welcome spot to have our meetings. I circled David, round him up. Well, we're thrilled to have you all here today for our March meeting. We have a great presentation coming up with Jenny Hill Bratt and Sara Pike of Withers Bergman. And we'll give you a little more background on that in a bit. I just want to go through a couple of announcements as we come forward. We do have one of our newer members. I'm not sure if he's here, Chris Sitchell. He's the new CEO of Rancho Santa Fe Foundation. And many thanks to Christy Wilson, who was in that position for many years and has since retired. So good for her. Certainly for all of you, and of course, just seeing the interaction here as we got started, you know, it really is like old home week. So so nice to kind of continue and develop new relationships and catch up with people that that we've known before. But certainly invite other people, other colleagues in your firms or other advisors that you work with. We're certainly in that mode here of the more the merrier. Our sponsor for today's meeting is Paul Hines of Aspirian Wealth Managers. Paul.
Good morning, everybody. Good morning to everybody here in the room, and good morning to everybody out there in Zoom land. It's great to see everybody. So on December 1st, 2021, Hearthstone Private Wealth Management became Aspiriant. It was an all-stock merger, and the 7 of us joined a team of 220 people in 11 offices across the nation. So I just wanted to go over a few things because some people might be wondering what's changed. I'll start with what's the same. So if you look at this, you can see the column on the left pretty much matches the column on the right. So what's the same? We're still independent, objective, all fiduciary all the time, 100% employee owned, always striving to get better, and all clients are clients of the firm. That's the way we were, and that's the way we still are. What else is the same? On the left, you can see a marketing message that we had, and on the right is a marketing message from Experian. Pretty similar, trying to exude the warmth. Okay. There we go. What else has changed? Our footprint in San Diego is quite a bit larger. Again, we went from 7 people. This is the wealth management team. So 10 people in wealth management, plus there's about a half a dozen more people in other parts of the firm here in San Diego. What has changed is what we can offer. So the advantage of scale. The advantage of scale allows us to offer more to our clients, including family office services. So we've gone from being able to offer wealth management to a whole lot more. Experian also has attorneys on staff, CPAs on staff, not to compete with other advisors, but to provide perspective and advice to our clients. I think I mentioned Experian is nationwide. There's 11 offices across the country, 15 billion of assets under management. So we use that scale for the benefit of our clients. Who do we work with? Corporate executives, business owners, inheritors of wealth. The 3 main service offerings we have is we provide services to professional fiduciaries, total wealth management, and I mentioned before the exclusive family office. So that's it. Just wanted to make sure that everybody was caught up with what we're doing. Really looking forward to the presentation from Jenny and Sarah, and look forward to talking to each of you a little bit more about it.
Paul, thanks so very much. We really appreciate your sponsoring this event. And Chris, welcome to you and Experian as you all come together. Moving on to our next meeting, which is April 5th. We're going to have a presentation by Kristen Caverly and Lisa Roper of Henderson Caverly, who are going to present on death during divorce, the impact on spousal property rights, certainly the real world of it all. And I'm going to just move off to one speaker. There we go. Katie Swafford is here to provide Hot Topic, and she's going to be covering the Britney Spears case part 2, as well as the newly originated legislation revolving around that.
Good morning, everybody. Okay, good to see you. So if you were here last month, you'll recall I talked about the Free Britney bill, aka AB 1194, which Governor Newsom signed last fall. It went into effect in January, and I was limited to 5 minutes to talk about this massive bill, which is 33 pages long. So I was asked to come back today, and I figured I would cover another part of this bill in 5 minutes because there's just a lot of information there. And it sounded like you guys were all really interested in what is truly a hot topic in the news. So anyways, one of the things that I didn't cover in the bill are the new rules relating to professional fiduciaries. And you guys may have seen or heard about the movie called I Care a Lot. And Rosamund Pike starred in it, and she got a Golden Globe, I believe. And it was about this lady who, in the movie, they called it guardianships, but it was the equivalent of conservatorships in California. And she goes around and basically goes to court and gets these elderly, wealthy people put in conservatorships or guardianships and takes over their assets and sells their assets and steals them and does all this bad stuff. And it's supposed to be it wasn't a true story, but supposed to be kind of depicting things that actually go on. And I can tell you, I have watched other documentaries on Netflix addressing similar issues. I don't remember what they were called because I watched them years ago, but in other states, my impression is that the abuse is much more rampant than in California. California does actually a pretty good job handling conservatorships. But nonetheless, this is what we are hearing in the news and in the movies. So California wanted to address private professional fiduciaries and create new rules for them. And this all emanates from the movies and the documentaries and of course, Free Britney. So also a part of this bill are these new rules. So for example, a professional fiduciary with a website must post their fee schedule on their website. And if they don't have a website, they need to figure out a way to give it to all of the persons involved. And I think this really stems from in the movie and what you hear about in the press is these professional fiduciaries are going around ripping people off and they don't even know how much they're going to have to pay out of their estates to the professional fiduciary. So they want more, the government wanted more open disclosure about their fees. There are also lots of rules that are meant to restrict a professional fiduciary's license or impose sanctions on them. So the Professional Fiduciaries Bureau, which is the bureau in charge of regulating professional fiduciaries, now must impose sanctions on a professional fiduciary's license upon a finding of the violation of applicable statutes or regulations, a breach of fiduciary duty where there is a finding of serious financial or physical harm or mental suffering, or when the fiduciary engages in specified acts of abuse. Also, if a professional fiduciary abuses a conservatee, the professional fiduciary is liable for a civil penalty of up to $10,000 for each specified act of abuse. The Professional Fiduciaries Bureau is required to investigate specified allegations and authorizes the Bureau to impose a restitution order on a professional fiduciary for the violation of any duties. And finally, the bill requires the Professional Fiduciaries Bureau to revoke a professional fiduciary license if the professional fiduciary knowingly, intentionally, or willfully violates a legal duty or breaches a fiduciary duty to a client, or if the professional fiduciary causes serious physical or financial harm or mental suffering to a client through gross negligence or gross incompetence. So, and there are more rules relating to professional fiduciaries. Those are basically the highlights. This has stirred a big, huge controversy in California because there really isn't actually a lot of evidence of professional fiduciary abuse in California. Like I said, California has done a pretty good job, and it seems like things are more out of control in other states, and that's really what the movie was depicting. But nonetheless, because of this perception by the public that fiduciaries are going around abusing people, this legislation was put in place, and a lot of people are not happy about it. So we'll see what happens. It may change, but for now, these are the rules. And everyone, the professional fiduciaries and the Bureau must abide by them. I'll also note finally that they only apply in conservatorship matters. So if you have a trust or estate matter, as of now, I don't think that these rules apply. So you have a little bit more leeway there. But in conservatorship, or in the movie, they call them guardianship proceedings, these are now the new rules. So that's it. If you haven't seen the movie, you should watch it. It's really interesting and will provide you with some context on what's happening up in Sacramento. Thank you.
Katie, thanks so very much for keeping us up to speed. Definitely an interesting case in the legislation that brought forward. Couple reminders of upcoming meetings. We've got, besides our April 5th meeting with the Kristen Caverly and Lisa Roper on May 3rd, we've got the next in our series on planning for real estate families with Robert Valera moderating a panel of Michelle Vivas of Douglas Wilson Companies and Tim Meisner of Meiser Commercial Real Estate Services. June 7th, we're going to have Wendy Goff, a good friend from Seattle, who's an ACTEC fellow, but with a passion on helping deal with drafting documents relating to mental health and addiction beneficiaries. July 6th, we're still firming up some things. July 5th, sorry, August 2nd, we're hoping to restart our planning, our business exit planning series. And we're hoping to explore the world of ESOPs. As some of you may know, my right-hand person, Bob Copeland, suffered a stroke some time ago and is still in recovery. So we wish him the best. Want to certainly bring up Pete Tentler to come in and talk about our trifectas. There he is. Pete is Mr. Networker.
Thank you. Getting, again, more positive feedback on the trifecta. So drop your name, your card in this basket, well, a fishbowl, I guess. And what we're doing is I'm trying to pair you up with two other people that are going to complement your industry. And this way you get together for coffee, lunch, happy hour, a hike, whatever. And you're just getting to know each other on a personal basis. And then hopefully you're going to be able to trust each other. Every once in a while, that's very rare, somebody says, well, we set this up and somebody didn't show. Please don't do that. I mean, we're all professional advisors here. Use this as a professional tool to get to know each other on another basis. If you haven't dropped your card in here this morning, we got a late start. It'll be at the check-in table. So drop that in there and I'll pair you up. Thank you.
Pete, thanks so very much. Certainly want to recognize David Jacobs of, there he is, a board member who's the man behind our website and our LinkedIn efforts. Certainly go to the website, update your contact information and your bio information. And certainly thank David for all the hard work that he's put in there. Without any further ado, want to introduce you to Jenny Hill Bratt of Withers Bergman and Sara Pike from Withers Bergman. We lost a little bit of time as we were getting organized, so I'll let them kind of kick it off and go from here. Do you want?
Thanks, Bill. I'm Jenny Hill Bratt, and this is my colleague, Sara Pike, and we're excited to be here to discuss tabloids and tax, a recent recap of press regarding tax planning for the uber wealthy. We have a lot of topics to cover, so we kindly ask that you hold your questions until the end of the presentation. And are there questions on the chat too? Okay, cool. Maybe we'll wait till the end just in case we run out of time. We have a lot to say. But Sara and I will also be around after the presentation and we can look through the chat and send people emails if that's helpful. As an initial matter, we thought it would be helpful to review the current state of the law. As I believe everyone is aware, Biden's Build Back Better bill did not pass. Thanks, Manchin. So we continue with the Tax Cuts and Jobs Act of 2017, also known as the Trump Tax Act or the TCJA. As of January 1 of this year, the estate, gift, and GST tax exemptions increased to $12,060,000 per person, or $24.12 million per married couple, less lifetime taxable gifts. The annual exclusion from gift and GST tax increased to $16,000 per donee, or $32,000 per donee if the donor is married. And the provisions related to the estate and gift tax exemptions continue to be effective until 2025. On January 1, 2026, the increased exemptions are reduced or sunset, and the 2017 rates will return. That is, the exemptions will be reduced to $5 million per person as indexed for inflation. So the advice continues to be the same. If the client has remaining exemption, use it before you lose it. But before moving on to the meat of our presentation, I want to briefly discuss reviewing and updating the credit shelter trust provisions of old trusts given the fact that we still are in this period of time with these historically high exemption rates. So the best advice, obviously, is clients should review their estate plan and make sure that the formula clauses and the credit shelter provisions are still appropriate. But what happens when a spouse dies and the surviving spouse sees that they have a exemption or a credit shelter trust that they do not need, either because of portability or because of their assets or because of both? So we've successfully dealt with this situation in two ways. First is decanting. This is the easiest, but if the trust is a California trust, the credit shelter trust has to give the trustee absolute discretion over principal distribution. So you can't, so the credit shelter trust can't be subject to a HEM standard. Otherwise, decanting will not work for purposes of dissolving or blowing up or modifying the credit shelter trust. So the second option is to go into court and do a modification under changed circumstances or a petition under changed circumstances. And this is under the probate code. And in our experience, judges have been very agreeable to these types of petitions. The increased exemption rates are clearly a changed circumstance. No one anticipated the rates would be this high when they put their estate plans in place years ago. And so long as none of the remainder beneficiaries object, we've found this to be a very useful tool. So without further ado, I'd like to turn things over to my wonderful colleague, Sara Pike, who's going to go through our agenda for the presentation.
Good morning, everyone. Thank you for having us here. So just a quick overview of our agenda for today. First, we're going to discuss qualified small business stock, or QSBS. Then we'll turn to private placement life insurance, PPLI. Turning to state tax, we'll discuss AB 150, which provided a workaround for the cap on deductions for state and local taxes. Next, we're going to go out of state and discuss certain jurisdictions outside of California that have advantages for high net worth clients' tax and estate planning, but which have also had recent negative exposure due to the Pandora Papers and some bad press. Finally, we'll touch on investing through a Roth IRA and the mechanics and recent news stories about supercharging Roth IRAs. Next slide, please. So turning to QSBS. By way of background, QSBS started in the early 1990s during the Clinton administration to encourage investment in startup companies. Congress created special income tax treatment for qualified small business stock. The QSBS rules allow for an exclusion from federal capital gains for qualifying stock sales in an amount up to $10 million or 10 times basis under current law. Furthermore, QSBS exclusion can be multiplied by transferring the stock to friends, relatives, or non-grantor trusts, each of whom will receive their own $10 million income tax break along with the transfer. Perhaps unsurprisingly, this ability to stack or multiply QSBS has garnered some bad press. This New York Times article called it a lavish tax dodge. There were some congressional proposals in the Build Back Better bill to cut the $10 million exemption in half to $5 million. And did not pass, but we will see if Congress attempts to pick this back up in 2022 or beyond. For the time being, however, QSBS and multiplying non-grantor trust provides huge income tax savings for eligible clients and families. And Jenny's going to take you through some of the requirements.
So the next slide, please. So we cannot emphasize enough how amazing QSBS is as a planning tool. As Sara discussed, it's been around for a while, since 1993, and the benefit depends on when the stock was acquired. The exact dates are in the slides, but for stock acquired on or after September 28th, 2010, a taxpayer will receive a $10 million exclusion or 10 times basis if greater from federal capital gains. QSBS is super cool, and that's why it's received the negative press. As a practice point, we need to have this on our radar, both for planning with clients who have QSBS, as well as informing clients who are forming businesses or who have existing businesses of the QSBS benefit. The QSBS rules are found in IRC section 1202. Some people refer to QSBS as 1202 stock, or you'll hear the phrase planning under 1202. In order to get the benefit of QSBS, you have to have stock of a domestic C Corp only. The stock needs to be issued directly from the company or received by gift or inheritance from the person who received the stock directly from the issuing company. At the time of issuance, the company's gross assets cannot exceed 50 million. At the time must use 80% of its assets actively conducting a qualified trader business. And how is a qualified trader business defined? Well, it's the IRS who loves super clear definitions. So the definition of what is a qualified trader business is actually what is not a qualified trader business, not confusing at all. So a qualified trader business does not include banking, finance, insurance, farming, mining, restaurants, hotels, and professional services. We'll get into those definitions a little more as we go through the slides. A very important note: California does not recognize QSBS. California does what California wants to do and not follow federal law. So when you sell QSBS, if you're a California taxpayer, you avoid federal income tax up to the limitations, but you still pay Sacramento, you still pay the Franchise Tax Board. So for our California clients, you pay the California tax unless you do additional planning, which we'll get to. We'll do next slide.
So just to touch briefly on what was proposed under the Build Back Better Act, the slide shows what was in the act passed by the House on November 19th, 2021. President Biden recently said that he still wanted to pass some of the parts of the Build Back Better bill in chunks, but hasn't specifically mentioned the QSBS sections. So I guess stay tuned for what's going to be proposed there. So in the version that did pass the House, exclusion rates for capital gain exceeding 50% would be prohibited for taxpayers with an AGI of $400,000 or more, or for any trust or estate. The proposed effective date would have been the date of proposal, September 13th, 2021. Which was an attempt to prevent a mad rush of transfers of QSBS being grandfathered in prior to the effective date of what legislation they had hoped to pass. Since it did not go through, we, as planners, have seen many more clients coming to us wanting to transfer and multiply QSBS now before any potential future changes.
So what is a qualified small business? So as discussed, the definition of what is a qualified small business defines what it is not. So we get to QSBS, and I quote, "It's any trade or business other than certain enumerated exclusions." So services in a broad variety of fields: law, accounting, healthcare, architecture, performing arts, financial and brokerage, banking and insurance. So basically everyone in this room, your businesses don't qualify for QSBS. I'm sorry. Sorry for myself. And there's other exclusions, which are farming, leasing, mining, extraction, operating hotels and motels. So what companies get the QSBS win? Definitely technology and pharmaceutical companies. The IRS ruled that companies that deploy technology, manufacturing assets, or other intellectual property to provide services can still qualify for QSBS status. The IRS has also ruled that a company that commercializes pharmaceuticals qualifies for QSBS. There are cross references in the Internal Revenue Code between section 199A and 1202, and we have regulations under 199A that provide a more enumerated guidance on what personal service fields qualify and which do not. So when I meet with a client that has existing C Corp shares, and usually it's C Corp founder shares, I ask, are your shares QSBS? And what's interesting is there is not a specific election that either that the company takes on the tax return. So it's not clear if a client has C Corp shares, if they are or not QSBS. So if the client is unsure, I bring in one of my corporate tax colleagues to confirm, but a lot of startups are now doing their startups using the C Corp formation to specifically qualify for QSBS treatment, like in anticipation of a future liquidity event. I've also worked with clients that have established non-C Corps, either S Corps or LLCs, that have done corporate restructuring to C Corps in order to get QSBS treatment upon liquidity. It's tricky, but it's possible. It certainly can be done. So $10 million exclusion from federal capital gains. That's pretty cool, right? But you still pay California capital gain. And what if the 10 million exclusion from federal capital gain is not enough because this company has just blown up bigger than the founder's greatest dreams? Wouldn't it be awesome if you could get more? Wouldn't it be awesome if you could avoid California tax? Well, the good news is you can through the use of trusts. So as I previously mentioned, 1202 applies for transfers by gift. So when a client comes to me with remaining estate and GST exemption and QSBS, we get really excited, like on a Zoom, like, yeah, here we go. This is gonna be great. So what happens is when you gift QSBS, the holding period tax. So you have to have the QSBS for 5 years. When you gift it, the holding period tax. So if your client has QSBS, your client can gift the QSBS. Obviously, there are outright gifts. The client can be like Oprah, you get QSBS, you get QSBS, you get QSBS, but we don't really want to do outright gifting, right? We like to use trusts, but we have to be careful if we're gifting through trust with QSBS. We have to be very careful with how that trust is drafted. So as I'm sure everyone in here knows, grantor trusts have been like the most greatest thing. Everyone loves grantor trust. Taxpayer pays the income. You can do sales. It's amazing. Grantor trust, not good for QSBS. We want to use non-grantor trust because we need the trust to be deemed as a separate taxpayer for income tax purposes. We want to use multiple trusts. So as the cool kids say, as Sarah said, we can stack or multiply the QSBS. We want to multiply non-grantor trusts because each trust can have its own $10 million exclusion from federal capital gains. For our California clients, we can set up non-grantor trusts or a non-grantor trust out in California, and then we can receive the $10 million federal exclusion for each trust, but it's a California trust, so then we're going to pay California capital gains. What if we set up the trust outside of California in a zero state income tax jurisdiction like Delaware, Wyoming, South Dakota, Nevada, Alaska, et cetera, and if the trust is drafted and maintained properly, we can avoid California taxation on that trust. These non-grantor out-of-state trusts have additional benefits. In addition to the QSBS, there's the 20% deduction for qualified business income. Each trust gets its own $10,000 SALT cap deduction. So we love QSBS, and we love it even more if we can stack or multiply through non-grantor out-of-state trusts. So on the next slide, Sarah is going to show us an example.
Okay, so this flowchart shows an example of how to use QSBS for a California resident and how multipliers work. The client, shown in orange, let's say has early stage stock in a company and has 3 children. She lives in California. The client has not used any of her 12.06 million estate, gift, and GST tax exemption. So she gifts 4.02 million worth of QSBS to 3 separate trusts, one for each kid, using all of her estate, gift, and GST exemptions. She makes these gifts to out-of-state non-grantor trusts in a no income tax state, as Jenny mentioned, Delaware, South Dakota, Wyoming, Alaska, or Nevada. The stock then appreciates and is sold. And what happens? Well, the client is still in California. So the client gets a $10 million exclusion from federal capital gains, but it's still subject to California tax. So the client has to pay 13.3% of that to California. California doesn't recognize QSBS, but each trust out of state receives its own $10 million exclusion. And because the trusts were properly established and maintained outside of the state, there's no California income tax. So this is also excellent gift, estate, and GST tax planning, since the grantor is reducing his or her taxable estate, gifting stock, excuse me, that is highly likely to appreciate, and all of the appreciation is realized out of the grantor's estate. Next slide.
With these multiple trusts, you do need to be careful. So under IRC 643F, 2 or more trusts are treated as one trust if they have substantially the same grantor and beneficiaries, and if the principal purpose is avoidance of tax. We have final regulations under 199A and 643F, and there were some proposed regulations under 1202 that didn't become final, and there were some scary examples, so I'm glad they didn't become final. But when creating multiple trusts with the same grantor, like in the prior slide, you have to be very certain that the principal purpose is not tax avoidance. In a lot of the negative press has revealed that there was some crazy abuse. Like people would create 5 trusts all for the benefit of the same person and put like little differences in each of the trusts. But they were primarily for the same beneficiary, and then took advantage of 5 $10 million exclusions from capital gains. So personally, I feel comfortable with the prior slide, which is one trust for each kid. In my opinion, the purpose of having separate trusts, one for each child, is so the kids are not connected with each other's financials or impacted by uneven distributions. Even when I'm doing plans that do not involve QSBS, it's very common, if not standard, to have separate trusts for children or separate trusts for each family branch. There is a concern about abuse in this area, even prior to the negative press. And that's basically too much stacking, too many trusts, that example of like 5 trusts for the benefit of the same beneficiary. Pigs get fat, hogs get slaughtered, right? So we just need to be careful that the principal purpose is not the avoidance of tax. Just don't be too cute. We are not going to get guidance or rulings on this issue. The IRS is donezo on issuing PLRs on this topic. So, and in the recent Rev Procs, they are saying we're not doing any more rulings on INGs or multiple trusts, and then multiple trusts is what impacts QSBS.
So in order to preserve QSBS status, you have to be careful with entities. If QSBS stock is held in a partnership, QSBS status is blown. Even a non-taxable transfer to a partnership will eliminate QSBS treatment. So the takeaway, don't get fancy. An unwitting advisor might first suggest transferring QSBS to a family limited partnership and then making a gift of the interest in the family limited partnership to take advantage of fractional discounting of the interest. By doing so, you lose QSBS benefits. Also, be careful with single member LLCs that own QSBS. If an election is made to tax the LLC as a partnership, or if the single member LLC becomes a partnership by virtue of addition of LLC members, the taxpayer will lose the QSBS benefit. And there may be other reasons to want partnership treatment. So you have to be careful since it's not compatible with QSBS. One recent example, we had clients who formed an LLC taxed as a partnership to take advantage of solar tax credits that required partnership status for the investment. And the clients owned the LLC as community property. So we looked into whether that for IRS purposes, as community property, would it be treated as a disregarded entity shared by the spouses or as a partnership? And the IRS has stated that they will respect the taxpayer's election to be treated either as disregarded or as partnership. The client can choose. So that's one situation where the partnership election could certainly blow QSBS treatment.
So we're turning now to private placement life insurance. What it is and what it isn't. Private placement life insurance is another great tool that has recently received some scrutiny from the press. So here we see some headlines, scary, scary, scary headlines. One article, tax avoidance trick that's only for the uber rich. How rich Americans plan to escape Biden tax hikes. PPLI is the perfect loophole. So what is PPLI and why are we hearing about it in the press? PPLI is income tax. It's an income tax strategy. So it's interesting. You hear insurance, and we'll get to this, and you think death benefit, but PPLI, well, there is a death benefit. It is a income tax strategy. So what's the current environment? Income taxes are high, shocking. I'm sure you came here to hear me tell you something that everyone knows and hears about. So over the past couple of years, I have personally, I think we've seen a tenfold increase in clients coming to us with income tax concerns and seeking income tax strategies. Top federal rate on ordinary income is at 37%. State and local taxes are no longer deductible. State taxes are high as ever. Everyone is aware that California legislature has had all these proposals to increase income taxes. And I've just seen such increased frustration with clients and a desire to seek or address these high rates. I mean, the number of conversations that I have had with clients about wanting to leave California, it is like, it's just in the past 2 years, it's wild. Also, investment management expenses are no longer deductible. So income tax reduction has never been more vital. And PPLI can be a really interesting strategy.
PPLI can provide huge income tax benefits. First of all, appreciation on investments held within the policy are not taxable during lifetime and can be redeployed without tax consequences. Next, the policyholder can actually borrow against the policy during life without incurring any penalties or tax. Since PPLI qualifies as a life insurance product, the income tax rules applicable to life insurance apply to the death benefit, i.e., the death benefit is exempt from income tax to the beneficiaries. And if the policy is purchased through a properly structured irrevocable trust, the death benefit is also not includable in the policyholder's taxable estate. PPLI investments can also be made in foreign funds without penalties. And although these structures do add some complexity in that they're, grantor trusts require setup fees and having the grantor trust, the gains within the policy don't require reporting for income tax purposes, and no K-1s are issued for the gains appreciation within the policy.
So let's start with a case study. We have our client here, Ellen Lord. She is a 58-year-old investor, and she's come to you asking for a mechanism to reduce her income tax bill. She's looking to reposition $2 million of investable assets. She wants to minimize taxes on investments. She wants to achieve a tax-free transfer to her children, and she's looking to protect assets from potential creditors. Now, I will say that now, obviously, we don't sell life insurance, but this example used $2 million. I'd say the threshold is generally about $5 million to do one of these. There's expensive fees sort of with getting it set up. And then if you do it through a trust, the maintenance costs, et cetera. But we use $2 million because I actually think the numbers work out nicely, which you'll see on the next slide. So to start off, you need to invest cash. This is not a pre-transaction strategy. If you need cash to go in. So if you transfer appreciated assets, it's going to trigger capital gains. So you have to have a client with cash. So here, Ellen has the $2 million of cash. So she's going to take $2 million, and we're going to see what this shows is how this works if she has the $2 million invested in the market, which is all the way to the right side, or the third column from the right is the end of your cash value with the investment inside the PPLI. This chart assumes that she gets a 7% net return. The PPLI generates 765,000 more than the taxable investment at age 68, so in just 9 years, and 2.5 million more than the taxable investment at age 78. In addition, there is the death benefit.
PPLI has advantages, especially if capital gain rates increase from the low present rate of 23.8% for federal, but there are disadvantages. First of all, the policyholder gives up management control over the policy investments. The policyholder has to either appoint an independent manager or invest in insurance dedicated funds, which some investors may find limiting. And next, the IRS rules require the accounts to be diversified. Jenny, can you give an example of diversification?
Sure. So I met with one client a couple of weeks ago, and he's a fund manager. And so he's like, I've heard about this PPLI, I've read articles about it. And what I want to do is basically wrap PPLI in my own fund. And this doesn't work. The insured cannot control the investments. The insured needs to hire a money manager. The client then was like, well, what if I invest in my friend's fund? And I was like, well, how many investments? Well, one, I wanted to get like one LP interest. And no, that doesn't work either. There is a diversification requirement within the policy. You have to have at least 5 different investments. PPLI works good for clients who are already invested in the market or invested in alternatives. So the growth, the dividends, the returns are all tax-free. I think of it like a traditional retirement account. It also works really great for alternative investments, private equity, hedge funds. It just can't be your own. So as the slide says, this is not your father's life insurance policy. When we think about traditional life insurance, we think about the death benefit. Again, the PPLI is we're really getting a nice income tax benefit as well as the death benefit. In addition, and as discussed, as opposed to a traditional life insurance policy where the returns are conservative and the insurance company dictates how the funds are invested, here the client can hire his or her own RIA or investment manager to invest the funds, and which typically are going to be producing greater returns than traditional insurance because they're not subject to all of the conservative federal regulations that are important for traditional insurance but aren't applicable for PPLI. So for clients with cash and a desire to create an income tax-free bucket, the strategy works. The assets that you think are going to greatly appreciate in the, or not, you can't put the assets in, but in that investment strategy through the PPLI can produce great results. And then just to sort of emphasize a point that we brought up earlier, if the client has remaining gift and GST tax exemptions, you can structure the PPLI through effectively a life insurance trust. So you set up the life insurance trust, you would make a gift of cash to the life insurance trust, and then the life insurance trust would turn around and purchase the PPLI policy. So during the grantor's life, the grantor is getting the benefit of this tax-free growth. And then at the grantor's death, the death benefit within the policy would transfer to the grantor's heirs or designated beneficiaries free of estate and GST tax.
Now we're going to turn to AB 150, the California SALT cap workaround. As probably everyone in this room knows, the Tax Cuts and Jobs Act created a $10,000 cap on federal deduction for state and local taxes. SALT. The SALT cap really hit high income tax states like California. And prior to the cap, the average SALT deduction in California exceeded $18,400. And so in effect, the SALT deduction cap of $10,000 created double taxation for many California residents. Taxpayers were paying federal tax on amounts that they paid in state, local, and property taxes. So there have been congressional proposals to raise the cap to $80,000 from 10 currently. But these reforms are unlikely to pass the Senate currently. So California did its own legislation, and along with nearly 20 other states, California now offers a workaround for the deduction for pass-through entities. So this would apply for partnerships, S corporations, and some LLCs.
So thank you, California, for once. AB 150 was signed into law last year and it became effective on January 1 of this year. It does have a sunset in 2026, and this is the second sunset that we've already talked about during this presentation. Lots of sunsets. Look out for the green flash in 2026. So what does AB 150 do? It creates a workaround for the current $10,000 limitation on state and local taxes, state and local tax deductions under TCJA. It's also known as the California Pass-Through Entity Tax, or the PTE. It allows a taxpayer or an entity to make an election to pay tax on pass-through income at the entity level, which allows the owners to bypass the federal SALT limitation. Some of you, and actually I was wondering this too, I was like, why in the world would Sacramento do anything to help its taxpayers? Like, this just doesn't, like, what? This doesn't make any sense. But if you check out the illustration on the next slide, you'll see that the state coffers don't lose a dime. Oh, not in the one more slide to come. Sorry.
So here it's, again, just going over who gets the benefit from AB 150 and how the benefit works. So most pass-through entities can qualify for the pass-through entity PTE tax. Partnerships, multi-member LLCs taxed as partnerships, and S corps can all qualify. And it works like this. Each qualified owner makes an election for the entity to pay a 9.3% tax rate on their share of net income, and then the owner receives a credit on their personal income tax return. Each owner in a partnership can make a separate election for the entity to pay and then receive a credit. They don't have to all make the same election. And then the business gets to deduct its SALT payments because the SALT cap limitation only applies to individuals, not to businesses. So the PTE tax enables qualified entities to deduct their full SALT payments on their federal taxes. This graphic shows 20 states that have adopted similar legislation as a workaround to the SALT cap, and the 5 more shown in yellow have proposed PTE bills.
So here is the chart that illustrates how this works. One of my super smart income tax colleagues made this chart, and it really helped me understand the mechanics of how the PTE works. So let's assume a partner in a partnership has $1 million of ordinary income from the partnership and is taxed at the highest rate. Without the PTE tax, the partner pays $370,000 of federal tax and then $133,000 of California tax. So she's taxed at an effective rate of 50.3% and brings home $497,000. The next column shows how the PTE tax works. Here, the partnership consents to pay the 9.3% entity tax. So this brings the partner's K1 income down to 907K. This then reduces her federal tax to a little more than $335,000. But her California tax effectively stays the same. So that gets to what I was talking about, like, why would California allow us to do this? It doesn't impact California. So this reduces her effective tax rate by 3.44%. And she walks home with now a little more than 531,000, or 32,410 more than she had before the PTE tax.
And this just shows some of the headlines which you can see, as well as probably from our own experience living in California, the SALT cap is super unpopular in California. With AB 150, business owners will get some relief from PTE tax legislation. And again, stay tuned to see whether Congress will pass legislation raising the cap or eliminating the SALT cap prior to 2026.
All right, we're leaving California and we're moving to South Dakota and Wyoming. Last year, we saw the Pandora Papers, not to be confused with the Panama Papers. So here's some headlines. South Dakotans loved our state bake laws, but now the downside is clear. South Dakota, a worldwide destination for foreign wealth. So what are the Pandora Papers? It was actually, it was about 11.9 million of leaked documents. And the leak exposed the secret offshore accounts of 35 world leaders, including current and former presidents, prime ministers, heads of state, as well as more than 100 billionaires, celebrities, and business leaders. A lot of what exposed was absolutely illegal, and it was mostly in the foreign context. And as a result, we have had clients having hesitancy to use South Dakota. South Dakota is a great jurisdiction for PPLI, to kind of circle back. Every state has a premium tax on life insurance, as I'm sure the life insurance folks in this room know. And South Dakota has the lowest in the country. So South Dakota is a great strategy for clients thinking of doing insurance planning. But after the Pandora Papers came out, I had a couple clients be like, I don't know, am I going to get in trouble? But we thought it'd be helpful to assure you that South Dakota is still an excellent jurisdiction. We're not paid or even licensed in South Dakota, but it's still a useful planning tool. Wyoming, on the next slide, has also gotten some bad press. And I think of all the headlines, this is my favorite, the cowboy cocktail. I might need one after this presentation. But again, Wyoming's becoming one of the world's top tax havens. But again, Wyoming, another excellent jurisdiction for the out-of-state planning structures that we've discussed.
So as Jenny mentioned, recent years have seen several exposés on lifestyles of the rich and powerful. Edward Snowden, Panama Papers, and most recently the Pandora Papers. So for our field, estate planners, advisors, Pandora might have been the most damaging because they exposed that the world's most secretive trust and business jurisdiction was actually within the US rather than in offshore jurisdictions. Or that was kind of the takeaway depicted in the press. South Dakota was exposed as a haven for tax dodgers and hiding funds of questionable sources. So in Pandora, there were 206 United States CITES trusts identified as having connections to some internationally nefarious people. 81 of these were in South Dakota. 30 of those 81 were connected to persons who were on watch lists for fraud, bribery, or human rights abuses. So there was, meat to the story. However, like Jenny was saying, for our purposes, not dealing with, those types of people, South Dakota still has a lot of advantages for insurance policies, using dynasty trusts, and also for its silent trust and privacy laws. It has no state income tax, no tax on undistributed net income, the lowest premium taxes for life insurance. And it also has litigation privacy laws where in the course of litigation, certain types of information cannot be released to the public.
So what we typically see in South Dakota and Wyoming, as well as all the other out-of-state jurisdictions that we've mentioned, are directed trusts. And we thought this diagram was useful in showing how the directed trust structure works. Directed trusts are not permitted in California. They are not in the probate code. And I think it was like 7 or 8 years ago, TexCom, the executive committee of the Trust and Estate section of the California Bar, tried to get a directed trust statute passed in California. And California was like, yeah, no, not happening. So interesting. Sometimes I'll look at trust and I'll like, it's a California trust and it has this like directed trust structure. And I'm like, that doesn't really work. And I think you have to be careful if you're ever sort of seeing a trust that's a California trust that has this directed trust structure. I mean, effectively, and there's not case law on this, but effectively, I believe that California would deem everyone as a fiduciary, everyone having like equal powers, everyone being treated as a trustee. So it doesn't work in California, but it's a really great structure that Californians can use as long as they set up their trust out of state. So here we have a family trust, and we call it the John Doe Family Trust. But oftentimes when using a directed trust, we do not use the client's name for privacy purposes. I would say that when we're having an initial meeting with clients for their first estate plan, their first revocable trust, and we go, what do you want to name the trust? And a good percentage of the time, the clients go, ooh, well, we don't want to use our names. We want to get privacy. And I explain to clients that with the revocable trust, you can't get any privacy. And that's because the components of a trust is the name of the trust. Okay. You can do some cute name. The date of the trust. Okay. That can be private, but then the trustees. So with a revocable trust, the clients are the trustees, typically 99% of the time. So we don't get privacy. But here with the directed trust structure, we can get privacy because with the directed trust structure, the clients are not the trustee. In a directed trust, we use an administrative trustee. This is typically, it's a third party. It's usually a trust company located in the jurisdiction of choice. The administrative trustee owns the assets. It establishes and maintains accounts, prepares and signs tax returns, produces trust statements. But when it comes to the two main functions of a trustee, distributions and investments, the directed trustee or the administrative trustee has no power. The administrative trustee, while it owns the assets, it doesn't have the power to make distribution decisions or investment decisions. It has to take direction from the distribution committee when it comes to distributions and the investment committee when it comes to investments. On the investment committee, you can have the grantor of the trust serve on the investment committee or be the investment advisor. There is not a Internal Revenue Code 2036 issue with that. The distribution committee, however, though, that does need to be not the grantor or not the beneficiary unless certain safeholds are put into place. So that's the directed trust structure, and that's the structure sort of one of the reasons why we like using these out-of-state trusts, because we can take advantage of the directed trust structure. All right, Wyoming, cowboy cocktail or tax haven. So one of the, oh, that's you. Sorry, I'll just keep on talking.
So this Wyoming is another state that got some negative press in the wake of the Pandora Papers. And it was called by the Washington Post one of the world's top tax havens. The state gained notoriety because it is very flexible in its use of private trust companies, which are special purpose companies set up to act as trustee of directed trusts. So this can allow for a level of secrecy, but also a level of privacy that many clients find attractive. And Jenny's going to walk us through the structure.
So private trust companies are really interesting and super fun, but they're not ideal for every client. They're not even ideal for every high net worth client. But for the right client, they can make sense. California is the fun police again. California doesn't allow for private trust companies. But in states with a modern trust code, such as Wyoming, they're available. So a private trust company is formed to serve as a trustee of an irrevocable trust, which in turn holds LLC or other corporate holding companies. Wyoming allows for both regulated and unregulated private trust companies. Now, there is some international pressure for Wyoming, South Dakota, Alaska, Delaware, and Nevada to change their privacy laws to provide for less secrecy. There's new anti-money laundering regulations at the federal level that may increase regulatory oversight, but this is really for the international investor. We don't think that these limits are going to apply for domestic investors. I find the private trust company structure useful for clients who already have multiple irrevocable trusts, and they're looking to either reduce corporate trustee fees and or consolidate management of the family irrevocable trust structure. They are expensive to set up and they are expensive to maintain. But for the right family that already has a family office structure in place, the PTC can actually save on administrative expenses. So effectively, the family and advisors create a private trust company, and some family members can even serve on the private trust, in the private trust company. The private trust company, as this diagram shows, is owned by a purpose trust or a special purpose trust, and the private trust company serves as the trustee of the various family irrevocable trusts.
Okay, coming to our next topic. We're going to talk about investing through a Roth IRA, and this has got.
Can I ask you a question on that? For the directed trust and the Wyoming cowboy cocktail or tax haven, what sizing are you guys typically focused on?
So you mean what should the value of the assets in the trust?
Yeah, to make it worthwhile.
I would say at a minimum 5 million. They're pricey to set up, but then they're also pricey to maintain. So, and even I did plenty of clients who want to invest or who want to set up a trust, using their exemptions, sort of going over that 5 million mark. But then when we walk through the ongoing administration expenses, they're like, no, I'll just stick with California. You also have to involve other parties. So, I mean, in California, clients love giving the assets away, but remaining as their own trustee, even though we say, oh, it's not as good for creditor protection reasons, and you're still going to pay California income tax, et cetera. But with the directed trust structure, you are paying a corporate trustee an annual fee every year per trust. The cheapest we see is in Nevada, and that's around $2,500 per year per trust. It's more expensive in South Dakota and Wyoming. It gets even more expensive in Delaware. And it's interesting because that's sometimes once clients have sort of done this with multiple trusts, and they sort of have like multiple irrevocable trusts, and they start adding up this administrative fee for all these directed trusts, they go, wait a minute, I should just create my own private trust company, because it will result in savings over the long term. That's kind of a long-winded answer.
And as an aside, it's not only Wyoming, other states like Nevada also have the structure. Okay, so Roth IRAs. Recently, a certain private equity mogul generated a lot of press for sheltering a lot of income through a Roth IRA. So that's right. It was Peter Thiel, founder of PayPal and early Facebook investor. He was completely roasted in the press towards the end of last year for sheltering $5 billion from through investing in his Roth IRA with low value shares, and then reaping huge benefits from gains, which he will be able to withdraw tax-free once he reaches 59.5. He may not need the money, so if he doesn't withdraw the funds, they pass to his beneficiaries free of income tax to the beneficiaries as well. Build Back Better did propose changes to the Roth IRA rules for these large Roths, which the changes would have forced distributions for Roth IRAs worth more than $20 million, and would have curbed contributions if the total retirement account funds exceeded $10 million. These changes, of course, didn't pass, but it's on the radar for Congress, we think.
So I know at the North County Estate Planning Council, there's like, and just over the years, lots of talk of like doing like Roth conversions. And so I feel like this is something that has been on our radar, all of our radar for a long time. After the press about what Teal did, it didn't happen to me, but it happened to some of my partners. They got angry calls from clients being like, how have you not told me about this strategy? So it's something that it's just like on my radar now because I'm panicked about getting some call, even though I'm sure everyone in this room is like, yeah, Roth IRA, we've heard about that. But just to kind of brief overview of the Roth IRA rules. So direct contributions to a Roth IRA are able to be withdrawn tax and penalty free at any time. Earnings can be withdrawn tax and penalty free after 5 years if the owner is over age 59 and a half. Rollover or converted before age 59 and a half, those contributions held in a Roth IRA may be withdrawn penalty and tax free after 5 years. Distributions from a Roth IRA don't increase your AGI. And Roths, but traditional Roths have a contribution limits based on filing status and income. So for a lot of our clients that don't already have a Roth in place, their income is such that they wouldn't be able to create a Roth. And so we would do a we would do a traditional IRA conversion for them. So then they sort of have that, pay the income tax, and they have that Roth bucket. This graph is just shocking, and you can see why it got the bad press. So Teal opens up the Roth in 1999. He buys super cheap founder shares of PayPal at the end of the year. At the end of the year, the account was worth $1,664,000. Today, his Roth is worth $5 billion. And then what the chart sort of shows is had an ordinary investor maxed out their Roth contributions every year since 1999 and just invested through the S&P, the value today would be around $260,000. So he got the benefit, obviously, because he put PayPal stock, like founder share PayPal stock. But for clients that, and we're seeing this obviously in the Bay Area and a lot more now in San Diego, clients that do have access to these startup companies, et cetera, using the Roth as like their little piggy bank for startups that they think are going to be successful could be a useful tool to try to mirror what Peter did.
I think we missed one slide. Back. So this is kind of the how to supercharge a Roth IRA. If you have something to put in it, as Jenny was saying, like founder shares or startup stock. So the client can make annual contributions if they're not above the income limits, or do a conversion into a backdoor Roth IRA. Tax is paid upfront on the contributions. And so one consideration is that if a client is contributing private company shares, traditional custodians, Schwab, Fidelity, Vanguard, may not be available, but there are other custodians who can who will oversee private company stock within Roth IRAs. And then when there's a successful event, sale, IPO, et cetera, the shares significantly increase in value. But once funds are in the Roth IRA, the client can do other private company investments within the Roth. And that is not a withdrawal and not a realization event for tax purposes. So one consideration on that front is that if other investments are done within the Roth, it's a good idea to silo into multiple Roths to ensure each investment is separate. And then after age 59 and a half, the owner can take tax-free distributions, and there are no required minimum distributions. Roth funds are includable in the owner's estate for estate tax purposes, but then passed to the beneficiaries free of income tax. Roth IRAs are subject to the 10-year distribution rule under the Secure Act. So beneficiaries have 10 years to take all the funds out. One interesting point on Roths is that California also recognizes the income tax-free treatment. So unlike QSBS, where California still would tax the gains, inherited Roth funds for beneficiaries are free from income tax for both California and federal.
So that takes us to the end. Bill, I don't know do we have time for questions? Okay, you want us to go to not how, well, we'll just go for questions then.
Don't spend a lot of time on this, but real quickly, Alaska, what's Alaska considered the sort of the place for wildlife disaster protection, for insurance, and some of this? I mean, what did you see with Alaska? Did South Dakota surpass it with recent wildlife?
No, Alaska is still Alaska is an excellent jurisdiction as well. And it's certainly like on the list of jurisdictions that we offer and that we use for our clients. It has successfully avoided bad press, to my knowledge, as of today, even though what Alaska does is exactly what South Dakota and Wyoming are doing. Yeah, you're welcome. Yeah.
Sarah, you mentioned siloing different investments in the Roth IRA. We used to do that when we could recharacterize. Take the ones that went down and recharacterize those back. Why would you do that now?
In case something went awry. So if you somehow would make a mistake with the Roth rules, and it would be taxable, if one of the investments were not structured properly, you wouldn't want it to be together with other investments in the same Roth. Just as like a extra safe kind of safeguard.
Yes. Yeah, so I've talked to, oh, sorry. So the question was, there are a lot of, I think, spouses that own, spouses together own a single member LLC that owns investments. And it's treated as see-through for income tax purposes. So what do you do with that LLC to get this all work around? So what you can do is elect to have that LLC taxed as a partnership if the spouses own the LLC as community property. So you could elect to treat the LLC for tax purposes as a partnership. And then, yeah, I know, bada bing, bada boom, it's pretty exciting. Yeah. But not if, yes, that's exactly, but not if it owns QSBS. Yes, exactly.
But if it owns real estate or some, non-QSBS, that's fine.
Yeah, but that's such a good point. And that is like an example of just like how careful. I just say with QSBS, don't put it in an entity. It's shares of stock. Don't put it in an entity, because you could just totally see people were rushing at the end of the last tax year to make the election for the SALT workaround. And you could totally see like just forgetting, inadvertently being like, oh, we'll tax it a partnership to avoid so we can get our deduction and then blow QSBS. Let's do it. Well, you have to tell us who it is. Okay, she's a friend.
What provisions in an out-of-state non-grantor trust could result in California income taxation?
Great question. Okay, so you have to be very careful that there are no California fiduciaries or anyone with a role in this directed trust that California would deem to be a fiduciary. Some of these states that we've rattled off will allow for the distribution advisor or the investment director to act in a non-fiduciary capacity. But even though that's permissible under state law, it makes me I wouldn't do it. So when we're doing these non-grantor out-of-state directed trusts, I do not let my clients appoint anyone in California to serve in those roles. Is there anything else?
But I guess generally it would be the trust, well, the distribution and the investment committees and the trust protector.
I think you're okay.
Maybe.
Yeah, no, I
You're-
think you're okay with the trust protector. But it was, it's interesting though, that there was a recent, the issue with this, and this is what I always tell clients, that California hates this. They hate these out-of-state trusts for income tax avoidance purposes. And I think it was during the pandemic, I was on a CLE with people from the Franchise Tax Board, and the questions like this came up. And in some instances, and it was in the context of a trust protector, they were saying, if the client is California and is a trust protector, that would not cause inclusion. But if the child beneficiary was the trust protector, that would cause taxation inclusion for California purposes. And that's like nowhere in like the California tax code. And so I guess it's a good question from Roberta, and it's something that we have to sort of warn clients about. Like California wants to attack these things. And so all we can do is how we know it works today. And if they change the rules, we'll have to pivot. Yes. I'm totally rolling my eyes because, yeah, no, it's not good. It's not good. So, so the question was, can you elaborate on income versus guaranteed payments? So a lot of partnerships, specifically like law firms, accounting firms, they are partnership for partnership tax purposes, but there is a guaranteed component to the compensation. It's not just like a true partnership where you just share in the profits. There's a guaranteed portion. And currently, that guaranteed portion it does not qualify for the SALT workaround. Now, in other states, they have modified their legislation to allow for guaranteed payments to qualify for the SALT cap workaround, but we don't have that yet in California. It's a good question.
Another online question. It's from Buddy Thomas. Please clarify California's treatment of VIG.
Oh, you're fine. You're fine. You're doing great. You're doing great. So if you set up an out-of-state intentionally defective grantor trust, which I think that's what the question is. Idiots, yeah. So if you set up an out-of-state intentionally defective grantor trust or a grantor trust, so you could be like, I'm going to set it up in South Dakota, but it's a grantor trust, which means the grantor is responsible for the income tax. Even if it's an out-of-state trust, California is going to see who the grantor is, which is a California resident, and then California will tax the trust.
Thanks so much, Jenny and Sarah. Boy, a lot of meat in those 5 little techniques there that we covered. And thanks for addressing the credit shelter trust. And obviously the moral of the story is to review your documents and get them up to date. But that was really driven by me with people asking me questions. Well, what if we didn't ever update so thanks for adding that into the piece. So thank you all for coming. Thank the Zoom folks for being part of this. Certainly come on down because it's great to be together here and network and such. And we'll see you on April 5th for the next presentation with Kristen Caverly and Lisa Roper. Thanks so much. Bye-bye.